In the world of trading, it feels like there's a new, shiny strategy popping up every single day. But what if I told you that one of the most powerful foundational ideas is actually over a century old, and it's still incredibly relevant? Okay, let's dive into the absolutely timeless principles of Dow theory. And yeah, it's a totally fair question. I mean, we've got high-frequency trading, AI, a global economy that moves at the speed of light. So how could something from the age of steam engines possibly keep up? Well, as we're about to see, the core human logic behind it is just as solid today as it was way back when. All right, so let's meet the guy behind all this, Charles H. Dow. Now, you've definitely heard his name, from the Dow Jones Industrial Average, or maybe from a little paper he co-founded called the Wall Street Journal. This was a guy who was just obsessed with figuring out how markets really worked. Now, here's the wild part. Dow never sat down and wrote a book called Dow Theory. It didn't happen. Instead, his genius was kind of scattered across a bunch of editorials he wrote. It was only after he passed away that other brilliant folks like William Peter Hamilton and Robert Rea looked at his work and said, whoa, there's a pattern here. They're the ones who pieced it all together into the theory we know and use today. So, what's the big idea at its core? Put simply, Dow theory says the market discounts everything. What does that mean? It means every single piece of known information. We're talking economic reports, political news, even what investors are feeling. It's all already baked into the price you see on your screen. It was basically the original efficient market idea, long before it became a textbook term. Dow's observations were eventually organized into these 6 core principles. And listen, these aren't just some dusty old rules. They are the absolute building blocks for pretty much all modern technical analysis. Let's do a quick flyby before we zoom in on the most important ones. Okay, so we just talked about principle 1, the market discounts everything. Got it. Now, principles 2 and 3, which we're about to get into, are all about how trends move and the stages they go through. The last 3 are about confirmation, making sure different parts of the market agree, that trading volume backs up the move, and the golden rule, a trend is in motion until it's proven to be over. We're going to focus on 2 and 3 because that's where you really start to understand market psychology. You see, Dow didn't see the market as just one random squiggly line. He saw it like the ocean. The primary trend is the main tide. That's your big bull or bear market that can last for years. The secondary movements are like the waves on top of the tide. These are the corrections and pullbacks that last for weeks or months. And the minor trends, those are just the ripples, the day-to-day noise that, honestly, can just distract you if you're not careful. This one is pure human psychology on a chart. Every major trend starts with the accumulation phase. This is when the smartest, most informed investors are quietly buying in. Then comes public participation. This is when the trend is all over the news, it's obvious, and everyone starts jumping in. And finally, you get the excess phase. This is when things get crazy, driven by hype and pure speculation. And that's usually a warning sign that the party's about to end. Okay, theory is great, right? But how do we actually use this stuff today? How do we turn these classic ideas into a simple, straightforward strategy that works in our modern markets? Let's take a look. The modern twist on this is beautifully simple. Just 3 rules. First, we use a clean line chart, not candlesticks. Why? Because it helps us focus only on the closing price, which Dow thought was most important. Second, we stay on timeframes of 15 minutes or higher. This helps filter out all that distracting market noise. And third, we add just one simple tool, a 20-period simple moving average. This helps us see the short-term trend at a glance. And here's what that setup looks like in the real world. Super clean, right? Just a simple line chart, and you've got that orange 20-period simple moving average laid right on top. The rule of thumb is dead simple. If the price is hanging out above that moving average, our bias is to buy. If it's trading below it, we're looking for chances to sell. It just gives us a clear directional bias from the get-go. Now this is where the rubber meets the road, the execution. See how the price is consistently staying above that orange 20 SMA? The game plan is to wait for the price to pull back a little bit, creating what we call a higher low, and then you look to enter a buy trade as it starts to move up again. Each one of these little dips is a potential entry point, all based on Dow's original idea. So let's boil it all down to one crystal clear rule. If the price is above the average, you're hunting for those dips, the higher lows, to buy. If it's below the average, you're waiting for it to pop up a bit, creating a lower high so you can sell. It's a really systematic way to trade with the trend, which is the entire spirit of what Charles Dow was trying to teach us. But, no system is perfect. Let's be real. There's no magic bullet in trading, especially not one that's been around for over a century. So it's absolutely crucial that we look at both the good and the bad. On the pro side, it's incredibly simple and clear. It forces you to focus on the long-term picture, and it is fantastic at identifying the major trend. But what about the cons? Well, it's what we call a lagging indicator. That means it confirms a trend after it's already started, so you might miss the very beginning of a move. Plus, deciding what counts as a high or low can sometimes be a little subjective. So, this brings us full circle, right back to that big question we started with. After looking at all of this, does Dow theory actually hold up in today's wild, fast-paced, algorithm-driven markets?
The answer is a huge, resounding yes. But, and this is a big but, with a major caveat. The core philosophy, the big ideas, that markets move in trends and that you should trade with that trend, that is absolutely timeless. The saying, the trend is your friend, that's not just some cheesy phrase. It's a fundamental law of trading that comes directly from Dow's work.
The problem is, the world has changed a lot. Dow was looking at industrial stocks and railroad stocks to confirm market trends. Today, our economy is all about tech and services. Information moves instantly around the globe, and automated trading bots can create patterns that Dow never could have dreamed of. So just applying his rules literally, well, it's not going to cut it. And that right there brings us to the key takeaway, the bottom line. You can't just take a 100-year-old theory and apply it blindly. The real magic happens when you blend Dow's timeless concepts about trends and human psychology with the realities of our modern financial world. So the next time you pull up a chart, don't just see a random squiggly line. Try to see the tide, the waves, and the ripples. Try to spot those phases of accumulation when the smart money is moving, and the excess when the crowd gets too greedy. Because understanding these century-old ideas might just be the thing that gives you a much clearer view of where the market is headed next.